Financing international trade can be complex, and various methods are available to facilitate and secure the financing needed for cross-border transactions. Here are some common ways to finance international trade. 1. Open account terms. This is the simplest method but carries the most risk for the exporter. In an open account arrangement, the seller ships the goods to the buyer and trusts that the buyer will make payment according to agreed upon terms. This is a common practice in established long-term business relationships. 2. Letter of credit à credit. As mentioned in a previous response, an LLC is a widely used financial instrument in international trade. It provides security to both the buyer and seller. The buyer's bank issues an LC in favor of the seller, guaranteeing payment upon the presentation of compliant shipping and financial documents. 3. Documentary collections. This method involves using a bank to handle the shipping documents and collect payment on behalf of the seller. There are 2 types of documentary collections: documents against payment, documents against acceptance. 4. Trade finance loans. Banks offer trade finance loans specifically designed to meet the financing needs of international trade. These loans can be used by both buyers and sellers to cover various trade-related expenses such as production, shipping, and inventory costs. 5. Export credit insurance. Export credit insurance, often provided by government agencies or private insurers, protects the exporter against non-payment by the buyer due to various reasons, such as insolvency or political instability. This insurance can make financing more secure, allowing exporters to extend open account terms to buyers. 6. Supplier credit. Suppliers or manufacturers sometimes offer credit to buyers. This is common in cases where the buyer is a long-standing customer or has negotiated favorable terms with the supplier. 7. Factoring. Factoring companies can purchase accounts receivable from exporters at a discounted rate, providing immediate cash flow. This can be an effective way to access cash without waiting for payment from international buyers. 8. Forfaiting. Forfaiting is a method of trade finance that involves selling medium to long-term receivables to a forfaiter at a discount. This can be a useful way to obtain cash for export transactions with longer payment terms. 9. Export-import bank financing. Many countries have export-import banks or agencies that offer financing and guarantees to support international trade. These institutions can provide credit insurance, working capital loans, and other financial services. 10. Trade credit from a vendor. Buyers can negotiate extended payment terms with their suppliers. This allows buyers to delay payments while receiving goods, which can be beneficial for managing cash flow. The choice of financing method depends on factors like the nature of the transaction, the relationship between the parties, the amount of financing needed, and the level of risk tolerance. It's important to carefully consider the terms, costs, and risks associated with each method, and possibly consult with financial professionals or trade experts to make informed decisions for your specific international trade transactions.